Something is shifting in Canada, not loudly, not publicly, but with a precision that suggests preparation. A quiet repositioning, a subtle retreat, a strategic recalibration hidden in plain sight. Over the past 18 months, Ottawa has been making moves that, individually, seemed routine. Reallocations in federal spending, recalibrated international commitments, unexpected postponements of infrastructure plans, and a noticeable cooling in certain cross border collaborations. But when viewed together, these actions form a pattern, one that economists and geopolitical analysts are only now beginning to decipher. The deeper question emerges: is Canada preparing for an era in which the global system becomes more volatile, and doing so without formally announcing it? This isn't withdrawal, it's insulation, a strategic soft exit from overexposure. Here's the clue that raised eyebrows: Canada's sudden shift toward domestic supply resilience and sovereign resource control. It mirrors early-stage playbooks once executed by nations anticipating shocks in global demand, migration flows, or capital mobility. The timing is too aligned with global turbulence to be coincidence. When a country known for stability begins quietly stockpiling regulatory leverage and strengthening internal shock absorbers, analysts ask a different kind of question. What exactly is Ottawa expecting, and why now? For families and workers, these maneuvers might feel abstract, hidden behind bureaucratic language, but they influence everything from housing availability to trade-dependent job sectors. When a nation begins subtly rebalancing outward commitments toward inward fortification, everyday life shifts, sometimes before the public realizes why. Behavioral economists call this a protective pre-alignment, a posture institutions adopt when they anticipate long-term turbulence but want to avoid panic. If accurate, it means Canada sees a future that demands resilience over expansion, consolidation over exposure. But here's what makes the story bigger. These moves suggest preparation for something deeper than economic caution, something structural, something global. And the real question is not what Canada is doing, but what Canada sees coming, because the next layer reveals a system few have paid attention to until now. Canada's strategy only looks subtle from a distance. Up close, the adjustments are surgical. Behind the headlines, Ottawa has been quietly restructuring national risk exposure. Analysts often describe nations as entities with personalities, and Canada's institutional personality has traditionally been cooperative, open, and predictably aligned with multilateral systems. Yet now, something has changed in the psychology of its policymaking apparatus. The nation is behaving less like a collaborator and more like a guardian. This shift aligns with a classic institutional survival instinct. When global systems become unpredictable, resilient nations turn inward to secure leverage before volatility spreads. Look closer at the mechanics. Resource sovereignty tightening. Regulations are being refined to ensure critical minerals, energy flows, and domestic supply chains remain under national control. A defensive play usually triggered when global demand pressures start spiking. A quiet retreat from overextended commitments. Not withdrawals, just delays and reassessments. But the pattern is unmistakable. Reductions in long-horizon liabilities, rebalancing of regional platforms, and a cooling toward sectors vulnerable to international volatility. A pivot toward population and labor stabilization. Migration frameworks are being recalculated to protect internal affordability and labor equilibrium, especially in major urban centers experiencing stress. Investment refocusing. Emerging reports highlight increased emphasis on self-sustaining industries, sovereign digital infrastructure, and domestic innovation defense. These adjustments resemble strategies used by nations bracing for global fragmentation, the kind seen before major supply realignments or currency area turbulence. For ordinary people, the consequences are real. Supply chain buffers affect prices, labor recalibration affects wages, and resource sovereignty affects housing and infrastructure costs. Each quiet move shifts the economic ecosystem that families depend on. The psychology behind these decisions is not fear, it's foresight. Institutions act early because individuals cannot. When a state prepares for instability, it does so months or years before the public feels the tremors. But here's the part nobody expected. Canada's repositioning is not happening in isolation. Because while Ottawa adjusts its exposure, other nations are beginning to read the shift, and they're recalibrating their own strategies in response. And that's where the story expands dramatically. Once analysts mapped Canada's subtle adjustments, another revelation emerged. Other nations noticed, and their reactions reveal even more. International economic blocs have begun modeling scenarios that assume Canada is preparing for a long-term structural transition in global markets. Not a crisis, a reordering. The country's repositioning has been flagged in global commodity forecasts, supply chain simulations, and even housing market stress tests conducted abroad. Why does it matter so much? Because Canada isn't a minor player. It's a resource anchor, a trade corridor, a stability benchmark. When a stabilizer begins to hedge, it signals systemic expectation shifts. Historically, when nations with diversified economies quietly reposition, it precedes shifts in global cycles. Analysts draw parallels with Nordic realignments before the 1990s financial recalibration, Australia's resource repositioning before the 2008 commodity shock, East Asian supply chain insulation ahead of the early 2000s tech acceleration. In each case, the quieter the moves, the more significant the underlying expectation. Now, international markets are detecting similar signals from Canada. Commodity buyers are diversifying sourcing models. Trade partners are hedging shipping and regulatory dependencies. Global investors are re-evaluating long-term exposure to sectors reliant on Canada's outward orientation. Some see it as caution, others see it as a proactive adaptation to a multipolar economic future. For workers, retirees, and consumers around the world, Canada's shift operates like a psychological cue. When a stable nation becomes more guarded, it triggers what's known in behavioral economics as anticipatory adaptation, a tendency for markets and institutions to adjust before the full picture becomes clear. This shapes everything: pension allocations, commodity pricing models, long-term corporate planning, migration and labor strategies, infrastructure financing. International observers aren't reacting to what Canada said, but to what Canada signaled through action. And this is where the story deepens. Canada's quiet exit isn't just about protecting itself. It may be preparing to pivot into an entirely new strategic identity, one that could reshape its role in the global system. But the real impact will be felt not in boardrooms or diplomatic cables, but in living rooms. The most important part of Canada's quiet repositioning isn't what it means for markets, it's what it means for people. As Ottawa redirects focus inward, households will begin to feel the effects in subtle but powerful ways. Domestic industries may gain new resilience, but global affordability cycles, from housing to consumer goods, could tighten. In an interconnected world, a nation's defensive strategy can create ripple effects that reshape daily life. The deeper truth is that Canada's shift reflects a global trend. Countries are moving from openness to strategic containment. They're not closing doors, they're reinforcing frames. Here's where it becomes personal. Housing pressures may stabilize in some regions as population flows recalibrate. Consumer prices may become less sensitive to external shocks, but more reflective of internal capacity limits. Job markets may shift toward domestically anchored industries, strengthening some sectors while cooling others. Retirement systems may become more insulated from global volatility, but more dependent on national productivity cycles. Local infrastructure could receive renewed attention as long-horizon international commitments shrink. These impacts appear gradual, but behavioral economists warn that such transitions often accelerate once global conditions tighten. And global conditions are tightening. Families will navigate an environment where stability becomes anchored in national systems rather than international cushions. Canada's moves suggest a world entering a new phase, one defined not by chaos but by recalibration. Nations are quietly redrawing the boundaries of exposure. For viewers, understanding these shifts isn't just educational, it's protective. When countries begin rebalancing behind the scenes, the public doesn't feel it immediately, but by the time the effects are visible, the strategy is already years underway. And here's the part the media rarely discusses. Canada may be among the first to prepare, but it won't be the last. Because while everyone is focused on this repositioning, the real transformation is already unfolding somewhere else, quietly, and in places no one is watching yet. The next story reveals where that shift has begun. and why it may redefine the next decade.